Today, we will continue our painful series of reviewing high-yielding income ETF products and bursting bubbles that 100% yields year in and year out are not sustainable. Now, despite over 100 years of S&P 500 data to look back on that consistently show, on average, the stock market returns around 7 to 10% any given year, many new investors believe that they have found the magic beans investment that will somehow return 10x the S&P 500 every single year. Now, despite the stock market going up and down every year to get that average, because guys, the stock market, it doesn't always just go up. Sometimes it does go down as well, and it often goes down very hard. These high yield investors will tell you that these returns are guaranteed. Because so many things in life are guaranteed, especially a 100% return. They will tell you that there is no risk because, having a 100% yield with no risk, that sounds like a total green flag. Absolutely no red flags there, guys. They will tell you that I am a hater who's collecting my SCHD gold bars while they rack up shares of this wonderful new fund called ULTY or ALTI. This is another in a long list of shiny new YieldMax products. Well, you know what? I want a 100% yield too. I decided it's time for me to read up on ULTY or ALTI and collect that 100% yield for my quest of getting more cash flow and being a high yield dividend warrior. ALTI is the YieldMax Ultra Option Income Strategy ETF. What a strong, powerful name to get me more in dividends, dividends. YieldMax does a wonderful job on explaining the fund and its pros and cons. But clearly, many people, they don't like to read. No surprise there. The fund is actively managed. It gets monthly income by having a portfolio of different covered call strategies. In huge, bold letters, it clearly states the fund is involved in a high degree of risks. I sense the reason many investors don't notice or acknowledge this is because of the 100% in dividends yield that is also advertised right beside this. And who doesn't want a 100% return? Take my money, don't ask any questions, and I can retire early and drink margaritas on a beach. So ALTI owns about 15 to 30 different stocks, which are constantly changing. This is because the fund primarily looks at the implied volatility, or IV, of a stock. Implied volatility is a measure of how much people expect the price of a stock to change in the future. If the stock has a high implied volatility, it means traders and investors think its price could swing quite a lot. Now, if it had low implied volatility, that suggests that they expect less change. Implied volatility, or IV, helps investors and traders gauge how uncertain or volatile the market expects a stock to be in the future. Now, this is important because companies with a high IV generally have higher options premiums. That's how ALTI is able to generate these super juicy dividends. Higher IV means higher perceived risk and potential reward. Hence higher premiums to compensate for that risk. So when we look back at ALTI, they're screening stocks by IV levels, then they do covered calls. They have a lot of flexibility in market cap and sector to choose from. It's really a free range for them to just pick these companies without having to worry about stuff like that. Right now, they're dominated by the financial and tech companies, making up almost half the fund. And that's no surprise, as there's a lot of volatility in those sectors these days. Now, the fund's covered call strategy, since these companies are being held for less than 1 year, therefore any gains, if any, are likely to be subject to short-term capital gains taxes. That comes straight from the company's prospectus. I'll go over some of their current holdings, but these are constantly changing almost on a weekly basis. Unlike other YieldMax products, ALTI actually owns some of its underlying stocks in addition to synthetically owning them like you've been familiar with. We have some pretty high quality companies in here. Companies that I really like ARM Holdings. I put out a video on this semiconductor company that a lot of people are hailing as the next NVIDIA. Well, that might sound great. Like, after all, who wouldn't want exposure to the next NVIDIA? That does mean that a lot of expectation is already baked into the stock. And any little misses in earnings reports can cause huge crashes. ARM currently trades at an absurd 547 PE ratio. Typically, a PE ratio of about 25 is considered a bargain. That's obviously going to depend on a lot of things like the sector that they're in, but just keep that in mind. 547 PE ratio when 25 is considered a bargain. Cava is a fast-growing Mediterranean fast casual restaurant somewhat similar to Chipotle, trading at a 229 PE ratio. Him and Hers is an over-the-counter prescription company that sells... Yeah, well, this video will probably get demonetized if I finish that sentence, but who needs their products when looking at ALTI's 100% dividend yield can give you the same feeling down there. Gentlemen, take notes for your next date this Friday. You don't need any pills, you just need to look at your smartphone, see that 100% dividend yield, and you'll get the same effects. But just don't look at their PE ratio. That might ruin it, because they don't have a PE ratio. Him and Hers doesn't make any money yet. Guys, long story short, and no pun intended, this fund is able to offer such a high yield right now because it's chasing exposure to significant high risk, high reward plays. The companies it's holding can easily swing large percentages up or down any given day for no particular reason. That's what happens when you have companies with high IV. This clearly runs into issues with covered calls because any upside is capped for those positions, but it gives exposure to all the losses. Now, when you have huge swings like that, that's going to cause big problems. Now, I already know people are going to ask me, can they potentially make a lot of money in the short term? My answer to that is possibly. I'm not doubting that or saying it can't happen. But this strategy, it makes absolutely no sense to me in the long run for a long-term buy and hold investor. And people can't time the market, so take that as you will. Now, great ETFs, they take into account company fundamentals or track an index. ALTI is just going to be taking a look at the IV for the next week so it can get the highest premiums. And that's fine. Maybe that's what some people want. It's great that we have so many choices in life, and not every ETF is exactly the same. If it works for you, you do you. Just remember, there is a difference between investing and gambling when it comes to the stock market. With investing, the primary goal of the investment is to grow wealth over the long term by purchasing assets such as stocks that are expected to increase in value based on fundamental analysis, company performance, and several other economic factors. Now, with gambling in the stock market, gambling involves taking speculative positions with the aim of making short-term gains based on chance or luck rather than a systemic analysis of the underlying assets. Now, of course, I have to say the words that no income ETF investor ever wants to hear. NAV erosion. Since the fund's inception in March, which is just about 4 months from today's recording, the fund has already lost 33% of its NAV. Every single distribution date, it goes down, and it just continues to go down. This is certainly not sustainable. If we compared it to the S&P 500, even with dividends reinvested, ALTI is down 5%, while the S&P 500 is up a juicy 8%. Over a 12-month annualized view, ALTI would be down close to 16%, while the S&P 500 would be up 26%. That is a 41% swing. Now, I only chose the S&P 500 just to show a benchmark on why 99% of people are just better off not doing any investing themselves because they cannot consistently beat the market and would be better off just buying the S&P 500 index in most cases. It's actually pretty hard to get a negative return in a bull market. But congrats to ALTI, you have done it. Can you imagine how bad these returns would have been in a bear market? Imagine the stock market was actually doing bad. ALTI would be doing even worse. Now, ALTI charges 114 basis points expense ratio. That's $114 for every $10,000 invested. It's beginning to look a little bit more clear that the only ones currently profiting off ALTI are the fund providers. While the 100% yield might look shiny, just know dividends are never guaranteed. Over time, if this NAV erosion keeps up, that dividend yield, it will just be 0%. Come with me and you'll be in a world of pure imagination. Now, I'd love to hear what your thoughts on ALTI are below. I know some of you definitely disagree with me, and that's fine. I want to hear that in the comments as you hit that like button, subscribe, check out my full $200,000 portfolio on Patreon. My videos are always found in podcast form under the Collect Cash podcast name. Now, keep collecting those SCHD gold bars, and I'll see you in early retirement.